Welcome to Industry Insights. Thank you for joining us today. Today's episode is Access to Capital. Don't run out of it. We know how valuable your time is, and as always, I can assure you no matter what role you play in the real estate world, this is going to be time well spent. So if you're new to tuning in today, thank you. And be sure to check out our previous episodes, which are available in a few different ways for you. Online, you can access previous recordings at www.civicfs.com/industry insights. You'll find all of our previous recordings there. And you can also subscribe to our podcast found on Apple and Spotify. Just be sure to search Industry Insights with Bill Tessar. So it is my pleasure now to introduce today's special guests. We're going to start with our first guest, Robert Kang. Robert has been in the banking industry for 15 years and has been with First Republic for almost 5. As a relationship manager, he manages his clients' banking, lending, cash management, and wealth management needs, with his main focus being on building relationships with high ultra net worth clients and helping them achieve their financial goals from a banking and lending perspective. Robert is going to be speaking to conventional lines of credit today. And fun fact, Robert and his wife are expecting a son in August of this year. So congratulations and welcome, Robert.
Thank you for having me.
Of course. Next, we are going to welcome Kevin Gussenow. Kevin is a 30-year veteran in mortgage, including lending in conventional construction and hard money. He currently serves as a director for Advotech, a public mortgage QC company, for the past 11 years, and is currently doing business at Celebrity Mortgage. Kevin is going to be speaking today to true hard money, be it his money or syndicated money that he's raised to lend against a particular ask. And very fun fact about Kevin, he is the proud owner of arguably the best beef jerky company around, Gnarly Jerky. I'm going to spell it for you all who I know are interested. Gnarly, Gnarly Jerky. So welcome, Kevin, a jack of all trades.
Wow, thank you for that.
Yeah, absolutely. And I can attest, it is absolutely delicious. Lastly, we are going to welcome Vincent Chardulo. Vincent is the SVP of Capital Markets here at Civic Financial Services, and he brings over 10 years in the mortgage and finance industries. He has a wide spectrum of experience in traditional mortgages, international banking, analysis, capital markets. His expertise provides Civic with a balanced and dynamic capital market analysis for our optimal success. Today, he's going to be talking more on warehouse lines of credit and the business and aggregation side. So he is a dynamo, and we are very pleased to have him today. Fun fact, Vincent, his father, and his grandfather all have a hole-in-one on the same hole at Osiris Country Club in Walden, New York. So that is pretty epic. Thanks for joining us, Vinny.
Hey, Gina, thanks for having me. I don't think I've ever had anyone call me a dynamo before, so I appreciate that.
You are a dynamo.
Yeah, I'm glad this is recorded, so appreciate that.
Absolutely. So taking the mic with our panel today is our host, our very own Bill Tessar. Bill is our president and CEO of Civic. Over 30 years of mortgage experience. Bill previously founded and served as president of 3 different mortgage companies, skyrocketing their residential funding volume to surpass 35 billion. He recently just took Civic to surpass some major milestones here. These include, and are not limited to, 10,000 loans funded, 4 billion funded, and over 1 billion in funding in 2020 alone. So I note that because it's remarkable, first of all, for the private lending space. But when you add a global pandemic on top of that, that is something that we are all at Civic very proud of. Bill is a Glassdoor top CEO. He is a Housing Wire Vanguard Award recipient. And I know it's almost been a year, but he was the first private lending executive to speak out after COVID-19. And begin this forum here where we're talking, we're educating, and he's just giving straight talk about real estate today. This is not a Civic commercial. This is not selling you Civic. This is you as our partners in the real estate community and adding value to you and what you do every day. So today, we're lucky enough to tap into the knowledge and expertise of our panel of capital experts, in addition to Bill's. So without any further ado, I want to kick things off by welcoming our president and CEO, Bill Tessar.
Thank
Bill,
you, Gina.
over to you.
Thank you. I think I'd start by saying our three speakers I have either been a customer of, done business with, partnered with, or worked alongside of. So I do have some intimate knowledge of all three of them, and they're spectacular in their own special ways. And I'm excited this morning because I believe the single most important factor in wealth building is access to capital. And it's overlooked. And it really kind of came to light last month. I spoke to Greg Geiser. He's the chairman, CEO, and founder of Wedgwood. And if none of you know who he is, his company has purchased, fixed up, and flipped over 50,000 properties. So he had real good reference. And when we started talking to him about the skill sets and nuances that have made him successful, and we're all taking notes in real time, there were three particularly that I wrote down, and I worked alongside him for 5 years. And that was really the genesis of today's call. And so the very first one Greg mentioned was when he borrowed money, he always made sure that he paid it back. And so for all of us on the call, you go, yeah, no, of course we do that. Everyone does it. You get a credit card, pay on time, mortgage, pay on time, borrow from your parents, you pay them back. But you'd be surprised as to how many people will look for excuses in instances like the financial crisis or the pandemic, real or not real, and be able to support a feeling of maybe not paying back as agreed on time. He never did that. He also doubled down on lining himself up with line of credits, both personally and corporately, as he came out of those malaises of the financial crisis, and he diversified his capital sources. And so when you look back, like, yeah, he had some good buys, he's got an incredible system, but it really was all centered around capital. And so, my position is to work on your capital sources when you don't need it, so you actually have it when you do. And I guarantee everyone on this call, including me, has waited at one time in their life for that opportunity. The opportunity comes, the flip opportunity comes, a business opportunity, a partnership, an investment. And then the next thing is, okay, where do I get the money from? And for those that haven't saved, their coffer is full of cash so they could react to that. You then start going on the hunt. And I can tell you, 99 times out of 100, if you're looking for capital when you need it, generally speaking, you're not going to make the right decision. You're going to make the fastest decision or the most necessary, but not the right one. So like what I'm hoping to get out of this with these speakers is all of us can just kind of tap in on how does what Kevin or Vinny or Robert have to say that can benefit me tomorrow, not necessarily today. And so listen, we have 1 hour, and I've narrowed it down because we want to have a little bit of Q&A. And Gina mentioned Robert King. He's going to represent the conventional equity lines of credit, different animal than Kevin, hard money or true private money, and he'll represent that. And then Vinny Chardula for really the smaller middle-sized businesses on warehouse lines of credit. And then I'll do a little bit of the institutional private money, which is really an offset to what Kevin does in that we pool our funds together and we sell it on Wall Street. So I'm going to get right into it. I'm going to start with you, Robert. You're a relationship banker. You and I have done business together. It's a two-part question. How do you currently provide capital to real estate investors, and what's the capital source that you're providing?
A great question. And I think I'll elaborate a little bit more on what your introduction was. how is the bank going to get paid back, right? And that's where we really provide that capital. So we'll look at the collateral and see how much we want to leverage up on that specific collateral, as well as the warm body behind it. Where is the resource payments coming from? Where is the income sources coming to be paid back that collateral or the capital that we extended out? As well as, if something like a pandemic happens, where may there be a secondary source of repayment? So loan to values come into play, debt to income ratios come into play, as well as your credit. When we're lending money to you or providing you that capital, we're taking a snapshot of how your current life looks at that specific given point. Well, the credit score will then reflect on how responsible or irresponsible you've been in the past for us to feel comfortable with whether or not we want to extend that capital out to you.
So it really is getting to know the entire package differently than maybe straight equity. Yes.
Right. So that's the main reason why we love to build relationships, right? Get to know the individual, get to know who they were today, but 5 years ago, and where they're planning to go 5 years from now. And what does this capital really mean to them? How can we structure this to actually add additional value and help them to achieve their goals as opposed to potentially hinder them?
And just quick, small little story with Robert. I have, as Gina mentioned, I've been in the space for 3.5 decades, run mortgage companies. I don't have a shortage of relationships personally that I could go to handle any real estate needs that I have. My last real estate transaction that I acquired, I actually worked with Robert, and it was literally one of the easiest processes I've ever gone through in the middle of the biggest refi boom, when 60 and 90-day turn times are normal. And so I did feel the relationship part of that interaction with you and your team, Robert, and still do it to this day. And I didn't feel like a transaction. So it was a different feeling, and you delivered what you promised. So I appreciate that. I think about Kevin, entirely different, right? The hard money goes all the way back to if any of you remember Ames Home Loan, they had those commercials and the guy was on the boat and the sharks were kind of swimming around. They were really the first institutional hard money lender, but it was off the backs of private investors like Kevin, who either had their own or aggregated capital and were sharp enough to make decisions on equity financing. So maybe you could tell us a little bit about your business, Kevin, and how you go about evaluating a customer and where that money comes from.
Thanks, Bill. I'd say that I got interested in hard money back in the early 90s. They used to call them optometrist loans. They were 20 points and 20%. And I didn't have money at that time, but I said, when I do get money, I'm going to be one of these lenders. So when we look at clients today, obviously the optometrist loans are gone. But when we look at clients today, it's not only just the equity, but we talk to every individual person to get their story, get a feeling of who they are, their passion for the project, and how they plan to pay us back. So we look at the overall picture, but the main thing that we look at is the property first, their background credit, their ability to repay the property to the loan, and then the overall story. And if it all comes together, we usually put deals together pretty quickly, 7 days, 10 days. We have a private money fund. We make our own decisions. We're a lot different than our competitors in that we don't have set guidelines. So each deal is individual, and we look at it with an open mind. And we've been pretty successful with it.
Yeah, I will just tell you, I have placed and done deals alongside Kevin for over 20 years, and he's special in that the hard money space in general has some pretty hard characters. And if you think about what they're doing, they're taking their own money, they're lending it, and they're saying, if this good person makes a bad decision and doesn't pay me back, can I take this property back in time and recover my investment and accrued interest and be able to sell it in a way that I'm not going to get hurt? It's an entirely different set of optics than Robert has. And having been on both sides of the aisle, I can tell you, you have to put on your Superman cape and then your Batman outfit because they're two totally different superheroes. And then, that kind of transitions into Vinny. So, Vinny has really dealt more with businesses and warehouse lines, but as anybody on this call grows up and starts aggregating maybe more properties or loans, they're going to be in need of a warehouse line because there's just not enough capital. Even if we all put all of our money and all of our family's money and all of our friends of families' money together, it is not a big enough chunk or pile to equal what you can get through a warehouse line. So tell us a little bit about that, Ben.
Yeah, so if I were to, compare having access to a warehouse line against what, Robert and Kevin were talking about, I think there's certainly more barriers to entry, right? Like this is supposed to be for small to mid-size and maybe even large companies that, to your point, Bill, they want to aggregate a portfolio of assets as they're contemplating how they want to, sell them or whether or not they want to hold them for investment. And these financial vehicles can be extremely complicated, or they can be, fairly straightforward depending on what the intended use is and how large they are. So I'll give you, just a few thoughts on what we do here at Civic. I would say the warehouse lines that we offer to our correspondent lenders are probably more straightforward, and it's really predicated on size, and it's us being comfortable with the assets because we're heavily involved in the underwrite and we know what's going on every step of the way. If you're talking about a larger facility where the assets are going to be on there for a longer period of time, you as a borrower should really expect that you're going to be taken through the ringer as far as how you are as an operator, right? A lot of people, that is going to be the focus. And if you look at, Bill talks about Greg Geiser, and Greg Geiser's been obviously super successful in his business. And it is really because he is a great operator, right? When he is judged by the people that lend him money, he's judged on the fact that he is a great operator, and he's proven that over time. And he's got a really long history of, sorry, we're getting some feedback. But he's proven that track record over a longer period of time, and therefore the capital that's available to him maybe look a little bit different than what would be available to a smaller mid-sized company that's really just getting started out. That generally makes sense.
Yeah, and I guess let me just back up 11 months. 11 months ago, when the pandemic became national and it was on all the news, in our space, in the business purpose loan space or the private money space, all warehouse lines, Vinny would validate this, generated through Wall Street were immediately frozen. Immediately frozen. They were not flexing the lines. There were margin calls that were immediate because nobody knew what the value of the loan on Wednesday was relative to Monday. And it was much to do with nothing, but I think I think Wall Street has lost enough money over time when these events happen by not snap reacting that they snap reacted. And so when you talk about infrastructure and operations and the way you went about getting your warehouse lines, those were the ones that survived in our business. Even if they were on temporary pause, you still see those companies lending today, and good for them. Because if they weren't sound operationally, they would be like the other ones that aren't operating. And so I think it's a really good point, Vinny, and definitely different than the ones Robert and Kevin made as you start thinking about business. But I want to transition real quick and talk about like the right scenarios for your type of capital. And I'm going to start with you, Vinny, since I just left off. Walk us through, like, let's talk about maybe correspondent. Somebody wants to come get a $10 million line. Briefly walk us through how you're thinking about that borrower and what it would take to get that $10 million line.
Yeah, so, it really starts out from us understanding what they're doing as a lender and what their business looks like. Like I said before, we are more comfortable because the warehouse line that we offer is for loans that look like the loans that Civic is originating every day, right? These loans are being originated on Civic documents, Civic underwriting guidelines. Where it gets, I guess, more involved from a borrower perspective is you're going to be providing a ton of documentation. It is really a corporate due diligence that takes place. Ours is a little bit less cumbersome than maybe what you would see for a larger facility, but we would expect to see financial statements. You'd be maybe required to provide guarantees depending on how large the facility is going to be. You're going to be restricted on how long you can keep loans on the line because the intent is that you're going to be moving them quickly, right? And we're here to provide a service to you so that you can recycle your cash.
Yeah, and I think just to add to that before I go over to Kevin on right scenarios for your type of capital, there were moments for this group where Vinny, myself, and our team were in New York. We would be there 3 days and we'd go see 25, 30 different capital partners to make sure that we had the right capital, not when we needed it. We had a plethora of lines and we had plenty of capability and openness to lend. It was always like, are the margins a little bit tighter? Are the guaranteed fees a little bit tighter? Are they more open to the types of loans? Can they stay on longer? The haircuts less. And so all those, like once you get your first line of credit, or you have Kevin, like you're constantly trying to make sure that you have the best available in the marketplace. And it's an exercise all of you should jot down, no matter what it is you're doing with your business. And I don't know if you wanted to add to that, Ben.
Yeah, so I guess just to touch a little bit more about how it works, right? I think I left this piece out. So if you think about the folks that we're facing off to are lenders, so they're making loans to, real estate investors like yourselves. And when they make that loan, let's just say, for example, it's a $100,000 loan, we as a warehouse provider would give them an advance rate against that loan amount. And the advance rates can vary depending on products, so on and so forth. But let's pretend that we're giving them an 80% advance. On a $100,000 loan, they would be getting 80K back, right? So they've got a 20% equity position in that. They would get $80,000 back to go throw back into the business, create more loans. And then our expectation is once that loan is funded, really in fairly short order, they're going to be providing us documentation in a way that we can get it off the line and it gets purchased, whether it's by a company like Civic or other. For facilities where you're going to be holding on to those assets for a longer period of time, and they're really meant to, sit there and aggregate a pool, which you then would intend to bring to a market. It does look a little bit different, right? Because now you're talking about your income stream from those loans is tied up. Everything has got to flow through the warehouse line. So you're paying interest similar to what you would do if you just went to, Kevin or to Robert and you guys got a loan, you're paying interest. It works the same way on a warehouse line. And it's typically benchmarked to an index like LIBOR plus some type of spread. So, let's just say, for example, the loan was a 7% loan and you held that loan in your portfolio, but you had it warehoused. If you're paying LIBOR plus a spread and it ends up being 4%, you're only getting a net 3%, right? And you wouldn't get that until all of those proceeds actually funnel through your warehouse line. You're paying your interest and your fees and principal that's owed. You would basically get the difference, right? So it does get, as we mentioned before, it can become really complicated or it can be fairly straightforward depending on what your intended use is for those loans and how long they're going to stay on your line.
Yeah, ultimate leverage tool for scaling business for sure. But Kevin, when you think about right scenarios for your type of capital, like walk us through what that looks like.
So we're kind of open to every loan scenario. We'll do second trust deeds. We'll do the unusual deals. So a lot of the best deals we get are deals that nobody else wants to do. So we'll get a purchase loan. I'll give you an example. A couple months ago, I got a business manager who called me, said his client was ready to close a purchase, but the lender backed out at the last minute. He threw it at me, said they had 7 days to close it. The property was a historical landmark. It was uninhabitable. The valuation was almost impossible to realize due to the fact that there were no comps for that specific property within a 5-mile range. So I dove deeper into the deal. I got a personal financial statement on the buyer. I realized that coming from conventional lending, doing Fannie Freddie loans, jumbo loans, the person had a perfect credit, 760 FICO, had money in the bank, actually qualified with ability to repay on her tax returns. So she was a solid buyer. The property was the issue. So after getting her on the phone and hearing her passion and hearing what her vision was, I got past the valuation of it, knowing that she's going to put 30% into it and knowing that she's got all these visions, that I got the feeling that this thing is going to be a good loan. And to this date, so far, so good. So that's the kind of deal. And those are the kind of deals that actually that was a business manager I'd never dealt with. Another business manager had referred him to. Since then, I've gotten 4 more deals that were perfect for our capital. So those are the kind of deals we look for.
Yeah, and we had a example with Kevin and his group probably a couple months ago. We had a deal on the Strand, and for all of you that don't know where that is, that's like it's premier property, front row to the ocean in Manhattan Beach. Really, really high value properties, and the guy was in mid construction, probably 60-70% of the way there. I think he needed 7.5, and we were comfortable at like 6.5 or something along those lines. We were $1 million short, and Kevin ended up coming in with a second and crossed it with another property. So the guy had enough money to build. And we'll talk about it in a bit, but that particular borrower in a very short period of time got himself in a jam again. And so here, Kevin, I, and the borrower are trying to work through those deals because, you know, the plan changed, and he wasn't able to effectuate it quite the way he represented it. So here we sit trying to work through that. But the nimbleness and flexibility of Kevin and his team in the seat that he sits in is far different than what Robert might be able to experience when he's really focusing on high net worth, long-term relationships, multiple facet borrowers. And so round out that conversation, Robert, with really the right scenarios for your type of capital.
Yeah, I think one thing I forgot that I think is a huge value add is not only am I the face of my relation with my clients, but I also underwrite my own loans. So when someone comes to me with needing some capital, I'm not just collecting a package and sending it to an underwriter in the middle of the United States. I'm hand holding it from start to finish. If I have any questions, I'm picking up the phone and I'm talking to the client directly so I can understand what the full picture is. And I think that makes a huge value add, because when you're in a time crunch, I can turn around very, very quickly and get things done very, very quickly. As far as ideal clients are concerned, or ideal situations, I think it's just what makes sense, right? I can talk to you about a rate sheet, and I can talk to you about what we may feel comfortable from a cookie cutter loan to value, or how much we're wanting to do on an equity line on a primary versus non-owner OC. But in reality, in having a discussion with the client and understanding why they're needing this capital, where it's going, how we're getting repaid back, I think all kind of lines up to what the ideal client is or what the ideal situation is.
Okay, well, I'm with you, Robert, so I'm going to stay with you. Any caps to how high you guys are willing to go? Are there mins and maxes with your firm?
Yeah, so typically we'll lend more for owner OC versus non-owner OC. Right now, as far as cookie cutter, answer is concerned, we look at 60% CLTV. But there are many times when I've gone way above that because it makes sense. I can just think of a deal last week. I have a client that just started his own law firm. He was a W-2 wage earner his whole life, started his own law firm and needed some working capital to build up some funds to use for marketing. And of course, we're not going to give him a business line of credit because there's no business revenue. But we decided to give him a home equity line of credit because we felt comfortable with having collateral on it. Typically, we'll go 60%. We were able to go to 75% because we understood what the purpose of it was, and we understood who the person was behind that and how we were going to get paid back.
Okay. What about you, Kev? Any mins or maxes in what you'll lend?
We have no maximum. So if the deal makes sense, it's LTV based. So we'd look at $20 million deals, provided there was enough equity in the deal, and our loans are short-term, 12 to 24 months. So as long as the timeline works for us, we'll look at pretty much any deal that's out there, and even in a second position. As far as minimums go, we probably like to stay in the 400 and above range. It really, putting out the capital, obviously you want to put out more. You don't want to really do the $50,000 or $100,000 deals. It just doesn't pay. So 400,000 to unlimited is pretty much what we look to.
What's the biggest deal you've done against an SFR?
9 million on an SFR.
Multifamily or commercial?
We do 1 to 4 and apartments 5 and up. So anything that people live in, we'll lend on, basically.
And Vin, as far as mins and maxes for warehouse lines?
Yeah, so I think it really depends on, again, what we had discussed earlier. So if you were, a company that's looking for a warehouse line from some type of Wall Street institution, you're really going to have some type of size to make it worth their time. Like, these guys aren't going to be in the business of offering a bunch of, $10 million warehouse lines. I'd say you're probably talking, minimum size of 50 to 100 million. We're obviously a little bit different, right? A little bit more straightforward. But the size of that line is going to be pegged to what your net worth is as a company. Generally, how liquid are you? So, like, what's your liquidity, and then what type of assets are you putting on the line? And it's still a question of liquidity around those assets, meaning how easy is it for those assets to move in the secondary market, and at what price can they move for?
And really, what everyone on the call should know as it relates to warehouse lines, a lot more predominant on the conventional side of the business. The difference between a broker and a banker is that line. That line allows them to lend in their name, to be the lender of record, and then that loan is going to get pooled in that warehouse line and sold off. Whereas the broker would originate that loan and get to choose which banker they get to place with. But argue great things about both sides, having been both. More flexibility on the broker side. People come in and out of the market. You have visibility to that. On the banker side, you're going to make a little bit more money for every transaction you do, and you're going to carry the risk associated with making that more money and acting as a lender. I didn't ask any of you about prepayment penalties. Robert, do you have any prepays on your deals?
3-year, $500. So the line, as long as the line is not closed within the first 3 years, it doesn't need to be drawn. $500.
But they close it inside of 5 years. You charge $500, and that's that.
3 years. Yep.
And no, it doesn't matter the size of the line. It's 500 for 100,000 or 500,000. Okay.
Exactly.
It's almost negligible. What about you, Kev? Do you have prepays through your paper?
Technically, you don't want to lend your money for 1 month. So our deals are short term anyway, they're 12 to 24 months. So depending on what it is, if it's a bridge loan, somebody's getting a loan because they have to sell their property and they plan on paying me back in 2 months. I'm really not interested in making 2 months interest. So I might put a 4-month or 6-month guaranteed interest on that loan, but that would typically be the only prepayment penalty I would put on it. So if the deal looks like it's going to be a real deal and it's going to go for 8 months, 12 months, then there's no prepayment penalties on my loans. But if it's something I know that's going to be quick, then I'll put a guaranteed interest piece in there just to make sure I get what I should get, so I don't have to just keep turning the money over every month.
Yep. And what about Vin? Is there any prepays on warehouse lines?
Yeah, so we don't have a prepay on our Civic warehouse line that we offer to our correspondent lenders. But again, if you're talking about taking down a fairly sizable facility and you're asking a lender to set aside capital to make available to you, you should expect that if you're going to end that relationship early, you're going to deal with some termination fees on that facility. That would be, I think that would be common.
Thank you. So look, for the people on this call, we have a whole bunch of them that are just starting out in real estate investing, never requested your specific capital. I'm looking for like 1 or 2 bits of information or advice you can give them that they could walk away with and say, got it. I'm going to start with you, Robert.
Let me know what the capital is for and how you're going to be able to pay the bank back.
What about you, Vin?
I think it's partner with the right lender. Make sure that you're dealing with someone that understands your business. They understand how you're planning to use the capital, and just don't get overextended. Make sure you've got significant reserves in hand to deal with just market turmoil like we saw in the last 12 months, because at some point it will happen and you just want to make sure you're prepared for it.
I've been involved recently. Any of you out there involved in any Arizona real estate? It's popping. And what's happening right now is they're getting multiple bids, 10 to 12% above list, and some of those are cash buyers. And so, one of the things I think about and personally set myself up for is, if you have a line of credit and you didn't necessarily have all the cash, you can strike. And if you can close quickly, waive some contingencies, and you got the right property, and you're a cash buyer, that's that's a big both Kevin and how fast he can lend money allows you to be a cash buyer, and Robert setting up a line of credit allows you to be a cash buyer. And I do think that's a differentiator. What about you, Kev? Somebody on here wants this is some advice, 1 or 2 points that you could share with them.
I'd say make sure that you can afford it and you understand the terms of the deal you're taking. And then I also say make sure you do your due diligence, because it's not just the property, especially in like construction. Because I had a deal where we did a loan for a client, and it literally took 9 months for the city to put a gas line in. The guy had a 6-month loan with me, and it got extended. And you just have to do your due diligence, because you're always going to have things that come up, things that happen, and we have to work together. And honesty is the biggest part, because once there's honesty is broken and I can't trust the truth, then things get ugly and they don't go the right way. So those would be the main points I would stress to people.
Hey, Kev, you and I didn't talk about this prior, so I don't want to catch you off guard. But have you ever had a deal that didn't work the way you wanted to, and when it finally settled and you added up the math, you were on the wrong end of the deal?
Yeah, it kind of happened with that gas line, because I'm more of a friendly lender, and maybe too friendly to a fault. And the gas line took longer than it took. Then there was another thing and another thing. And it's timing. It's timing for the investor. It's timing for us. So when we do these loans and we map it out, markets change. And that property changed dramatically from the time it started to the time it ended. And I ended up taking a big loss on it, because when the market changed, a lot more properties became available and values dropped real quick. So really, when you take a project and I learn from it, the borrowers will learn from it, and we put personal guarantees on them too. So the key is to make sure you do your due diligence, because it cost me in the fact that I was a little too lax in that I let them keep going, extending. And then when it got bad and they stopped being good characters, then the process between getting the property back and getting it to market just took too long, and the market deteriorated. So yeah.
Well, yeah, I will second the notion that Kevin is guilty as charged. He is, for a private money lender, which is all about equity in a property and protecting your investment at all costs. Timing is everything. I will tell you that he, in 199 times I've done business with him or watched him do business, has always taken the high road. And I'm glad it's only that example, because you would think sometimes maybe you would get yourself in a jam by being more flexible and understanding of the situation, as opposed to you work it out. I have a first position and I'm going to protect my position attitude, which I've never seen you take. Hey, Robert, I'm guessing, and I've never asked you this either, but with your LTVs being so low and the net worth requirements and FICO, I'm guessing, has First Republic ever really taken a bath on a borrower in a deal, real estate, since you've been there?
Well, we're not perfect, but our defaults are very, very low. And I think our defaults are very, very low because, like I mentioned before, we as relationship managers work with the deal from start to finish, and we have to understand every little piece of that deal. But I think, don't quote me on this, but I think our default rate last quarter was 5 bips. So yeah, on our great SFR portfolio of 70 billion, I think it was $1 million. Something nothing.
Vinny, sorry that he didn't pay that loan on time. I need to tell you he's going to make it up on the next deal.
Yeah.
Just Vinny didn't borrow. Hey, so I do want to ask one more question before we go into Q&A. I'm looking at the time and we're getting there. And it's really just more any additional notes worth mentioning. You're going to give the nugget. Each one of you get to think about this. I'm going to start with you, Vinny. A takeaway for everyone before we go to Q&A.
Yeah, so to me, it's ease of use, right? When you're setting up a warehouse line with a lender, I wouldn't get, certainly the rate is important. You want to make sure that you understand what it's going to cost you, and that's got to be the right number. But at the same time, having a low rate with a lender that's hard to deal with, meaning you've got to jump through hoops to get your money, that's not beneficial either. So I would say focus on ease of use, and even if that's at you having to sacrifice maybe a little bit of cost, finding a partner that is easy to deal with and gives you very quick access to your capital is in the long run going to help you tremendously.
Yeah, and I'm going to send a personal invite to everyone that's on this call. If any of you are in the process today or tomorrow looking for warehouse financing, and you just want another set of eyes, I am offering up Vinny and myself to take a look at what's being offered and show you some of the areas that you might be able to sharpen your position, or some things you need to think about language inside. I'm not saying we're going to read hundreds of documents. There's fees involved. There's mins and maxes. There's you got your margin on top of your LIBOR. There's advance rates. There's 6 or 7 key things that we would look at. But we've looked at hundreds and hundreds and hundreds of different opportunities from players out there, and I would offer that to anybody here. Our contact number will be shared by Gina afterwards. So just pick up the phone and say, hey, I got Ishkabibble Bank that's offering me this, and could you take a look at it, and we'll get a set of eyes on it. What about you, Kev? Any additional notes worth mentioning for the team?
I'd say you've stressed it. Be prepared. We're not your typical lender, so obviously it's speed, but show us everything, because we're going to find it. So if we find it and you don't disclose it, your odds of getting a loan from me are probably slim and none. So just throw it out there and we'll put a package together. I'd say just be upfront and be prepared, and you'll have a better result by doing that.
Yeah, for what we've already determined as the nicest hard money lender in the space, one of the things that I know is important to you, Kevin, is the communication aspect. Like, you can't over communicate enough to you what you're feeling, what you're thinking, what you're worried about, so you can get in alignment and partnership with that particular borrower and feel connected other than just money you're loaning them. Agreed?
Oh, I agree 100%. I'd rather get a phone call than none.
Take us home with that point, Robert, before we go to Q&A. Any additional notes worth mentioning?
Yeah, I think character. I think character is huge, and I think character goes in twofold. So in the past of what your character looked like from your credit score, right? So if I were to look at someone, and I actually had a phone call yesterday. Someone said, "Oh yeah, I had a bankruptcy 10 years ago, but it's not on my credit report." Well, that just shows your character, in that, I don't know what caused you to get that bankruptcy, but that leads me to believe to be a little bit more cautious in lending you additional money. So character is huge from the past. And so be careful what your current debt obligations are and pay on time, as well as, the current offer. If I'm extending debt out to you and you promise me to bring X, Y, and Z to the bank, then meet your end of the bargain. And so in the future, when we do deals, then I know what type of person that I'm actually dealing with.
Yeah, and the thing I would add to what Robert just said in the example of bankruptcy, I would personally, if that was me, I'd lead with it. I would have my cover letter that leads with, 10 years ago, I was in partnership with Jimmy. I was a personal guarantor. He ran the business. I provided the capital and the PG. That business was XYZ. They ran it into the ground. I'm telling you an imaginary story. And I ultimately was obligated for hundreds of thousands of dollars, none of which I had. I had to file Chapter 7 protection. That was on this date. It was discharged on this date. And since then, I've learned a couple lessons. I don't sign for anybody other than myself, and I've established good credit. So, like, if there is something that you might not be super proud of, it goes back to what Kevin and Robert and really Vinny said: lead with it, communicate, have good character in disclosing it. They will find it. I mean, LexisNexis and all that stuff, even though it's not on your Experian, they can find those sorts of things. And so, better to put that out front. And if they have a problem with it, you'll learn from that experience and get to take that to your next lender. So Gina, I know we got a limited period of time, so I want to hand it over to you to see if we have any questions and answers so we can get those taken care of.
Yeah, absolutely. We have a ton of questions, so I'm going to try to get through these, and we'll move through as many as we possibly can. Okay, so first of all, many people have been asking for contact information. How do I contact Kevin? How do I contact Robert? How do I contact Vinny? So I have gone ahead and thrown their direct email addresses in the chat. So just refer to that if you didn't see that pop up already. So this question is for Kevin. Will you do DIP deals?
DIP.
This is from Lithia.
I don't know what a DIP deal
I
is.
didn't either, so I just thought that was an industry term I missed. Okay, so Lithia, if you want to go ahead and communicate through the chat to clarify on that further, we'll be happy. Debtor in possession. Thank you.
I'd have to look at it and do some more research on it, but I've never done one of those. So, but doesn't mean I won't.
As
Okay.
Jim Carrey would say in Dumb and Dumber. So you're saying there's a chance.
There is a chance.
Exactly. Exactly. So this is just kind of a general question that I thought I would throw out to everybody because there were a couple of these, but just asking for the maximum LTV and LTC for each of you.
Robert, you can start with that.
60.
Kev?
We'll go 70, 75, depends, 80 maybe, depending on the location and deal.
Yeah, on the warehouse side, it again just depends on the type of asset and how long it's going to be on the line. But seeing something in the 80s, and then sometimes you could even see something in the low 90s. But most of them that you're going to see would be 70 to 80.
And Vinny, so if you just look at the history of Civic, when they started, they were 75 advance rate, which, to use Vinny's example, if you do a $100,000 loan, you take 75,000 off the warehouse line and you got to put 25,000 of your own cash. When you're doing a bunch of loans, that's a bunch of your own cash in the warehouse line. We moved 75 to 80, we moved 80 to 85. And I think before we started balance sheeting loans, we got as high as 95, correct?
That's correct.
Now they get a little bit more expensive when you have less skin in the game, rightfully so. But yeah, and then I think we're 80 and 100, Gina, on the rehab.
Okay, perfect. Does Kevin do development loans?
Yes, we've done ground up construction, so we'll look at it as long as it's residential or apartment buildings. We won't do commercial.
Okay, and I'm not sure who this is directed to, but the question is, how do you disperse the loan to the borrower if it is financed for fix and flip?
How do you disperse the money to the borrower if it's financed for fix and flip?
And maybe they're asking about financed rehab.
Probably, I would assume, Bill, they're asking if it's a fix and flip, I'm sure a certain part of the money is put into a fund and it's dispersed as you complete that part of the construction in stages. And that's usually how it's done.
Yep.
Then
we go have an inspection, make sure that the work was done, and then we will approve X amount of dollars to be released to the borrower.
And there are questions about HELOCs on investment properties. Do you do them?
Go ahead, Robert.
Yeah, we'll entertain it. It's case by case, one deal at a time, and we do what makes sense.
Yeah, I think there's one big distinction. So you heard Robert earlier talk about lower LTVs. He's also got like ridiculously low price. And as you start ratcheting up your LTVs, you start introducing a higher weighted average coupon all the way to an 80, which would be really, or the olden days, as Kevin was talking about, the optometry loans, right? So I think there is a risk reward. Robert, lower LTV, much sharper price. Whereas as you get up higher in the Civic and Kevin categories, you're dealing with something that could be 400 to 600 basis points higher.
Okay, next question's for Vinny. Are warehouse lines for individuals or for businesses only?
It's just going to be for businesses. If it's for an individual, then that person is extremely wealthy. But I would say, yeah, it's really just going to be for businesses, small,
And
medium,
that,
large.
that person probably has an LLC or something to protect them anyway. So they'll lend it to that and they'll have the PG from the individual.
Yeah, so that's maybe to take it a step further, if you have a warehouse line and they can be structured a bunch of different ways, but if it's a repo facility, which is just a repurchase agreement that you have with your lender, they're going to expect that you hold these assets in a bankruptcy remote, special purpose entity, which they hold the certificate of. So it essentially looks like for the time that they are financing this loan for you as a lender, they could make the argument that they would be the owner of record, and you have an agreement with them to repurchase it.
Okay, thank you for that. Okay, so this next question is for Bill. What is the difference between private money and institutional private money?
Yeah, so really the way Civic began and has operated up till recently when we started balance sheeting more of our stuff was we had warehouse lines. We would lend and put those loans on those warehouse lines. And then we would take those loans and either do a securitization or we would sell those in some form of a pass-through interest rate inside of what we were lending, or sell the group of them as a premium. In Kevin's case, Kevin and his group of investors hold on to those loans, and he handles the servicing, the collections, the communications, the whole ball of wax. What I would tell you is Kevin is a junior form of balance sheeting. And if your cost of capital is inside of what you could sell it for, you should balance sheet everything. The problem is people don't have unlimited access to that sort of capital. And so you get to a point where you've aggregated billions, you have to trade some of that paper. So, institutional private money was something that I coined because it was different than the private money I grew up with, in that it was me and 6 of the individuals on this call. We each put up a couple $1 million. We had $12 million to lend, and we ham and egged our way with $50, $100, $200,000 loans at 12% and 5 points, and made a decent little living doing that. They call them country club lenders too. A lot of retirees have a bunch of money, country club, they get together and they get that money to work for them, right? And so I do think there is a difference between private or hard money and institutional private money.
Thanks, Bill. This question's from Mike, and I believe this is directed to Robert because Robert had mentioned the 3-year prepay penalty. So you mentioned the 3-year prepay penalty. What's the longest term of your loans?
So all home equity lines of credit is a 10-year draw, then amortize after, if there's a balance after that, to amortize for 15 years. So it's
I almost think 500 doesn't qualify as a prepay, just for the record. I mean, you could call it a termination fee, a goodbye fee. I mean, normally when you think about prepays, you're 80% of 6 months interest, or you're thinking about something significant. It's kind of a cutesy goodbye fee.
So that's specific for home equity lines of credits. Obviously, we have prepays on, call it financing on a non-owner occupied purchase or refinance, but specifically for HELOCs, 3 years, $500.
Okay, perfect. And this is directed just to everybody. How long would it take to get each one of these different capital options?
Start with the longest. It would be you, Vinny.
Yeah, so your typical run rate on standing up one of these warehouse facilities is probably like 90 days if you're talking about facing off to a Wall Street type counterparty. On the Civic side, 30 days is probably more realistic, and the larger and more complicated it gets, you can expect to add some time onto that.
Robert, I'll let you go because I think you're probably maybe the second longest.
Yeah, I'll say around 45 to 60 days are the turnaround times right now.
At Civic, we've done them in as soon as 5 days. I think we average like 12 days. And then Kevin does it. You ask him on Monday and your money's in your mailbox on Tuesday.
It was actually their Sunday. I beat
the day before because you knew I was calling.
Yeah, exactly.
What are you, like inside of a week, or depending on the deal and the need?
7 days is probably the fastest. Nothing more than, if it's a real deal, if it's a real deal, they'll know if I'm going to do it in 3, but to fund it, it's 7 to 20 days to get it done, depending on if I need an appraisal or something of that nature.
All right, and there are some pretty specific scenarios coming in through the chat. So I would just encourage you folks to go ahead and reach out to our panelists directly. They would love to look at those specific questions for you. One of the questions that has come in is specific for Bill, talking about rates and states. So where are your rates at now? And do you have any plans to lend in new states coming up?
Yeah, so on the rate question, get me that information and I'll send out our sheets for all of the states that we lend in. And yes, the answer is we are looking. What we do look at things a little bit different than others in our space. Judicial versus non-judicial, which basically for everyone on the call means the amount of time it would take to get the asset back if somebody stopped making payments. That makes a difference. We currently don't lend in New York. We don't lend in New York really for one purpose. One reason. One reason is that it takes you 2.5 to 3 years to get your asset back if someone stops paying. In my mind, you would have to drop your LTV so low in order to protect your investment that, you know, until there's a change in legislation where you can get the asset back quicker, we wouldn't go there. And then we just work on a demand pool. If I think we're looking at Ohio right now, and we just added South Carolina, we added Jersey, we added Maryland, Virginia. I'm probably missing a couple. I think we're at, help me Liz, 21, 22 states, something like that. Yeah.
Okay, and this is for Kevin and Vincent. Do you lend on land and construction at the same time?
So I just want to clarify, do I lend on the land to buy the land and then do the construction loan?
I guess let's just say, what's your position on land and construction?
So we will not lend on land alone. And if it was a construction deal, you would already have to have the permits and everything ready to go, and we'd have to look at it because obviously we're short-term lenders and timing's everything. So we need to plan it out and map it out and make sure those numbers work out.
Excellent.
So, Bill, you want to take this? I'm happy to speak to it, but as of right now, Civic's not making loans against land and or ground up construction. I mean, ground up construction is a product that we're seeing gain momentum for the counterparties that we have conversations with in the secondary market. It's something that's evolved, and I do believe it will be something that Civic will be offering sometime in 2021.
We're offering the ground up construction, not the land.
Correct. Yeah. Thank you for clarifying.
All right, well, we're at time, everybody. So before we wrap up, Bill, do you have any closing questions or remarks for our panelists?
No, I do think it's good to get everyone's contact information down because as you have individual scenarios, we'll take the time to address those. Our offering stands out for anybody on the warehouse side that just wants a second set of eyes. The way I look at it is lessons learned should always be shared and not kept secret. And so we're open kimono and would be happy to help anyone going through those. When for me personally, someone comes to me looking for an equity line, I would direct them straight to Robert. Someone comes to me as an institutional private money lender, and I see it as a more of an individual hard money or private money loan. I personally wouldn't use anyone other than Kevin. And I think Vinny literally is a premier expert when it comes to warehouse lines. He's looked at so many documents and knows right where to look in an agreement to bring value. And I think it's important, you all know that for us, it's not just about doing loans and making money on loans. It's how can we bring value in as many different ways outside of just doing the loan so that we develop long-term relationships. And that is the goal of these Industry Insights monthly calls. And so thank you, Kevin. Thank you, Vinny. Thank you, Robert, Gina, Liz, and everyone that took the hour to chime in. I hope everyone got at least one bit of information that's going to help you in your personal and business endeavors.
Absolutely. Thank you, everybody.
Thank you, guys.
Have a great day.